Good evening, everyone. A warm welcome to the first OCBC Premier Banking Investments webinar for the year, titled Navigating the Investment Landscape. My name is Kelvin from Wealth Management Singapore, and it's my pleasure to be a moderator for this evening's webinar. It is now my pleasure to begin the webinar by introducing our speakers from the OCBC Wealth Panel. First up, we have Vasu Menon, Executive Director, Investment Strategy for Wealth Management Singapore, OCBC Bank. And secondly, we have Carmen Lee, Head of OCBC Investment Research. So let's start with some poll questions to understand your sentiments about the current market outlook. You have a minute to submit your response for each question. Please click on the poll button to start. Okay, so for the first poll question, are you positive or negative about the investment outlook for 2020? Click A for positive, B for negative, and C for neutral. So Vasu, we have had quite a bit of a start to the year, haven't we?
Indeed.
With your experience in the markets, maybe you could share, have you ever seen a situation like this from the tail of 2019 all the way to where we are facing in 2020?
Well, you know, Kelvin, I've spent 32 years tracking the markets.
Wow,
I've seen several crises, several crises, and I can tell you one thing: that each time a crisis like this happens, it rattles the nerves of investors. It leads to a lot of doomsday forecasts. But eventually, when the crisis ends and the dust settles, this is when some of the most interesting bargains have emerged, and there's potential for very good returns, even in times of turmoil like that. So investors should not lose sight of the medium term.
Sure, and to that point, I'm thinking Warren Buffett even recently was mentioning that he's looking out for certain bargains in the market.
Of course, these are the times when bargains can emerge, but of course, timing is very important as well.
Sure, thanks so much for that, Vasu. So now let's turn to the poll results. So again, are you positive or negative about the investment outlook for 2020? We have actually quite a good split, actually. 50% of our audience is positive and 50% are negative. So interesting insights, especially since we come to the start of the year. Let's move on to the second poll question. So for the second poll question, which of these asset class are you most positive about for the rest of 2020? We have equities, bonds, multi-asset funds, gold, and of course, property. So Vasu, again, I think some very common themes with regards to property and even gold. And we have seen quite a bit of an upsurge in terms of gold prices recently.
Maybe you
have your thoughts on it?
When we talk to investors or investing in the markets, what comes to their mind essentially is equities and bonds, and perhaps multi-asset funds.
Sure.
But what's interesting is in the last 1 to 2 years, or even last 2-3 years, I think gold has started to emerge as a distinct asset class.
Sure.
Because we're living in uncertain times, many of these uncertainties will not go away.
Sure.
And gold is appealing in an environment like that.
Yep.
More than that, you also see central banks now starting to buy gold, individual investors buying gold, institutional investors buying gold because of de-dollarization, so to speak. And that has helped to result in structural demand for gold, helped to boost gold prices. Gold prices up 18% last year, 8% so far this year. So it's certainly an asset class for investors to keep their eyes on.
Sure, and I think the ever-old adage whereby when in doubt, buying gold, I think that still very much applies even
more
after
so
all this time, right?
In the coming years.
Yeah, so thanks so much for that, Vasu. So we've seen some of the results that are coming in. So again, very, very interesting. We are quite split up across all four asset classes. For 1/4 of our clients, they are looking at equities. The other quarter is on bonds, multi-asset, and of course, to that point, the last quarter they are looking at gold. So again, some very interesting insights coming in from the poll question so far. Yeah. So now moving on to the third poll question. For the third poll question, do you think the coronavirus, I think that's the key theme at this point in time, will it cause a sharp pullback in the global stock markets? Click yes, A for yes, B for no, and C if you are not sure. So, Carmen, I mean, we have seen quite big moves in terms of the major equity indices over the past couple of weeks. Maybe you could share some insights with regards to that.
Okay, I think if you look at it, since the markets, since the coronavirus, actually the markets have actually already corrected, especially for the Asian market. So we've seen some of the key Asian indices actually took a huge hit on that front. In the last 2 days, obviously, this has actually moved on to the European as well as the US market. I think if you look at the US market in the last 2 sessions, actually the decline was quite sharp.
Yes.
But having said that, I think that we have also seen how the Asian market have reacted to the news. First it declined, and then of course then it bounced back up again. And I think this will also be the similar trend for the US market as well.
Yeah. So I think the last few days, or even is probably indicative of the kind of volatility that we are seeing in the overall market so far. So thanks so much for that, Carmen. So let's move on now to the poll results. Okay, I think we probably can see a bit more a sense in the overall opinion this time around. So again, the question was, do you think that the coronavirus will cause a sharp pullback in global stock markets? I think just like what was correctly pointed out, I think the bulk of our audience, they're looking at, yes, that it has actually caused and will continue to cause quite a bit of volatility in the global stock markets. So again, some pointers that I hope you address as we go along. And finally, let's get to the last poll question. So for the final poll question, aside from the coronavirus, what do you see is the biggest risk facing markets this year? Is it A, the trade war, B, for the US elections, sharp economic slowdown in China, or for the last point, it will be Brexit? And Carmen, we have had quite an eventful 2019. 2020 seems to be continuing that particular trend. So maybe could you have your thoughts with regards to this particular question?
Okay, if you look at the coronavirus, the epicenter is actually in China. And as a result of which there were a lot of destruction to not only the factory production, also to tourism, transportation, etc., etc. And this has an impact on the Chinese economy. I think as a house, we are expecting about between 0.5 to 1% decline in GDP for China. And if that happens, the rest of the region will be impacted as well, because China is one of the key centers for sourcing of raw material as well as production of products. So we actually expect this to continue to dominate headlines for at least the next 2 to 3 months.
I think just the news events from the past few weeks, it just goes to show how interconnected the world is.
Indeed.
Yeah, we literally have one situation in one country that's causing impact, and I think things are quite different this time around as well. Yeah. So let's move on now to the poll results. Okay, and yes, I think again our audience is quite agreed here. Bulk of our audience is actually looking at the sharp economic slowdown in China. In fact, close to 70%. That will be the major factor that will be facing markets for this year. So again, thank you for your answers. And so let us now carry on to invite Vasu to share his views on the current landscape. So please, Vasu.
Thank you very much, Kelvin, and thank you very much, everyone, for taking the time to join us, to give us the opportunity to share our views on the global economic and investment outlook, which is what I'll be sharing about today, with a special focus on the coronavirus. Now, if you cast your mind back to 2019, 2019 was also a year filled with lots of twists and turns. We had the US-China trade war, which was a very big thing. We also had intense fears about a global recession. Now, despite all that, global equities appreciated more than 20% last year, while global bonds did well too, appreciating by between 9 and 14%. So the big question on investors' minds right now is, can markets continue to climb a wall of worries in 2020? It did quite well in climbing a wall of worries in 2019. Can it continue in 2020? And we do have quite a number of worries for 2020. We've got, of course, the number one on the charts, the coronavirus, which is clearly impacting nerves right now. We've got the US elections, which is probably going to come into focus in the second half of this year. We've got trade protectionism. Clearly, the phase one trade deal between US and China has been sealed, but will it hold? And will Trump open up new trade wars on other fronts with other countries as we go down the year? And finally, of course, Brexit, which has a deadline for the end of this year. So let's start with the coronavirus, which is clearly in the focus, which is in focus right now. 80,000 cases reported so far collectively. That's 10 times more than what SARS had. SARS, we had 8,000 cases. We got 80,000 cases. The focus, as Carmen said earlier, the epicenter of this corona crisis has been China. But in the last 4 to 5 days, the focus has slowly been shifting away from China towards other parts of the world. South Korea has seen a big pickup. We've seen a pickup in Italy. We've seen a pickup in Iran. And there are concerns that the virus could also spread in a bigger way into the US. So markets are now moving away from fears of an epidemic to fears of a pandemic. And that is clearly rattling nerves. Now, this chart will give you an idea of how the markets have reacted to fears of an epidemic and a pandemic. And you can see a very significant pullback in the markets. Global equities are down 6% since the 17th of January, which is roughly when the markets saw a turning point as far as the coronavirus is concerned. So, we have seen quite a bit of a correction, and we could see further downside, perhaps even in the short term. Now, if you look at how global equities have done so far this year, down 4%. So we've not gotten off to a very good start. The various regions, Europe is down 6% because I think the focus is now on Italy and whether the virus is going to make further headway in that region. Now, if you look at the bond markets have actually done better than equity markets. Bond markets have held up better. And one of the reasons for that is because, treasury yields have, in the US, have fallen significantly from 1.91% to 1.36%. That has helped bond markets. Of course, aside from equities and bonds, you look at gold. Gold, as I said, appreciated 8%. Commodity sector has taken a beating. The US dollar has appreciated 3%. Asian currencies have appreciated 2%. So a mixed performance from different segments of the financial markets. Now, should you be too worried about epidemics and pandemics like what we're going through right now? If you look at history, what history tells you is that, in previous epidemics and pandemics, 2002 SARS, 2009 the swine flu, 2014 Ebola, and 2015 Zika. During all these periods, what's interesting is the markets initially saw a sell-off, but 6 months after the outbreak of the virus, the markets saw a fairly decent rebound. So, what it tells you is that, yes, for the short term, it's something to worry about, but if you look out medium term, when this comes to pass, the markets could stage a pretty decent rebound down the road. Now, this chart gives you an idea of, how the markets performed during the SARS episode. And what's interesting is, essentially, the markets during the SARS episode fell by 15%, but only to rebound by 45%. So SARS started in November of 2002. It was first reported by China in February of 2003, and it was declared by the WHO as no longer a threat in July of 2003. And essentially, SARS, the infection started peaking in April of 2003, and the markets bottomed out around that period, and after which markets staged a very strong rebound. So, yes, things look very gloomy right now, but, there is light at the end of the tunnel for investors who are prepared to look out over the medium term. Now, this gives you an update of, let me just give you an update of, how the coronavirus situation is like. You can see from this chart that, the infection numbers are clearly picking up. You see that since mid-February, the infection numbers have been kind of leveling off, but still on the rise. So, no signs that the infection numbers are peaking just yet, which is what we're looking out for. What's interesting is that in terms of new cases have fallen off very significantly. Now, that's partly because of China. China has been quite successful in, tackling the virus, and I think the number of new cases in China have fallen significantly, and therefore the worldwide new cases have, started to ease a little bit. But on the other hand, if you look outside of China, you can see a big spike in the number of cases. So South Korea has reported a big increase in the number of cases. Italy has reported several cases. We've also had Iran, the Middle East reporting cases. So I think we're now into the second phase of the coronavirus. The first phase was focused on China, and the second phase is now whether this is going to spread to other parts of the world and become a pandemic. So that's, keeping, investors very nervous and markets extremely volatile. So what's the economic impact of the coronavirus? And will the coronavirus trigger a recession? I think these are key questions that are playing on the minds of investors at this juncture. Now, we look at the yield curve for some direction, the US Treasury yield curve, and what it tells you is that the yield curve is not signaling a recession at this juncture. The yield curve is still in positive territory. It has been flattening since the beginning of this year, which tells you that investors are nervous about the economic outlook, but we are not as bad as what we had back in August, September of last year when the yield curve inverted, went into negative territory. So the bond markets are saying, yes, you got to worry about the virus, but we don't see a recession just yet. Now, if you cast your mind back to the SARS episode, you can see that, it did have an impact on China's economic growth rate. And China's economy was growing at about 11.1% in the first quarter of 2003. But because of the SARS virus, that growth rate fell from 11.1% to 9.1% in the second quarter of 2003. So the SARS virus in 2003 had a 1 quarter impact on China before the economy started to turn around and recover. And here in Singapore, the economy grew at 1.7% in the first quarter of 2003. And because of SARS, again, we had a 1 quarter impact. The economy saw a 4.2% contraction, but then, the economy recovered soon after that. Now, I think this time around, things are slightly different compared to SARS, because China has now become a lot bigger than what it was back in 2002, 2003. Today, China accounts for 16% of world GDP. China only used to account for 4% of world GDP in 2002, 2003. China used to account for 5% of world trade in 2003. Today, China accounts for 11% of world trade. China is today seen as the factory of the world. It used to account for 9% of world manufacturing output, and today it accounts for almost 19% of world manufacturing output. China is today the largest exporter in the world, and China is also one of the largest importers in the world, importing things like commodities, oil, and also things like electronic items like integrated circuits, which are used by the technology sector. So clearly, China has grown quite significantly, become very interlinked to many parts of the world, especially Asia. This chart shows you the exposure of different parts of the world to China. Since 2002, China is now fully integrated into the global supply chain, and you can see that in terms of the global supply chain impact, it is the Asian economies like Taiwan, Hong Kong, Malaysia, Singapore, South Korea, Thailand, Vietnam. These are the ones that really are going to be impacted by what happens with supply chain disruption. The developed economies also be impacted, but less so. It's more Asia that is economically exposed to China. Now, as Carmen said earlier, we are projecting that China's economic growth rate will be reduced by between 0.5% and because of the coronavirus. Now, this is perhaps more aggressive relative to what the IMF is looking at. The International Monetary Fund has just announced that they are lopping 0.4 percentage points of China's economic growth rate. So they're projecting that China will grow at 5.6% this year compared to 6%. So we are a bit more conservative in our forecast. But as long as this is a short-term phenomenon and China is able to get back on its feet after the initial hit, I think global markets will recover and regain their footing. Now, what is the earnings impact of the coronavirus? I talked about the economic impact. Let me just focus a bit more on the earnings impact. On the earnings front as well, China is very interlinked to the world. It is, developed market companies derive quite a significant portion of the earnings from China. You can see that since 2006, that number has increased, that percentage has increased quite significantly. Now, if you throw in the emerging markets, they're even more interlinked to China, which is why developed emerging markets, almost 12% of the earnings are derived from China. And what happens with China, the impact China will face on the virus, will have an impact on earnings and therefore equity markets and bond markets as well. Now, if you look at this chart, it's an interesting chart. It tells you that the markets that are most exposed to China are actually the Asian markets in terms of their earnings exposure. And Singapore, Hong Kong, Taiwan, Australia, and Korea are the markets that have the biggest earnings exposure to China. These numbers for you to bear in mind as you look ahead. Now, not everything is doom and gloom. Clearly we are facing big challenges with the coronavirus, but policy stimulus could offer some buffer, right? So I think if you look at Singapore, for example, the government here has announced a very significant, sizable fiscal stimulus of $6.4 billion to boost the economy, to offset the coronavirus. And I think, you could see the same coming out of various Asian economies. China could do the same in terms of fiscal support, South Korea, Japan, Hong Kong. So governments in this part of the world, in other parts of the world as well, have the ability to spend, provide some backup support, to help offset the impact of the coronavirus. So it's not all doom and gloom. Policymakers have a say and they can help. And it's not just the fiscal policy that can help, it's also monetary policy. The central banks, the Federal Reserve has cut interest rates 3 times in 2019. They could cut interest rates again. In fact, the Fed Fund Futures market is pricing in more than 50% probability that the Fed could cut interest rates in the second half of this year. If you cast your mind back to the SARS virus in 2003, the Federal Reserve did respond with a 25 basis point interest rate cut. It took the interest rate, Fed fund rate down from 1.25% to 1%. So the Fed is ready to act. It is not just the Fed, it's other central banks in emerging markets, in developed markets that are ready to act if necessary, and that should provide some degree of comfort to investors. We have low rates right now, and rates are probably going to stay low for a fairly long period. and central banks could do more by way of liquidity injection. Now, this is going to be good for equity markets and bond markets. In fact, one reason why equity markets did well last year, despite all the headwinds on the trade front, and as far as fears of recession is concerned in 2019, is because the Fed cut interest rates, 3 times. Other emerging market central banks cut interest rates several times. And so low interest rates clearly helps to boost the prospects for equity markets. It also boosts the prospects for bond markets. And, you've seen high yield bonds, being sought after. And we think that high yield bonds will remain sought after in a very low interest rate environment and given the abundance of liquidity. So central banks have a big part to play in making sure that, we don't fall off the cliff. Now, let's now focus on other key risk factors. We focus so much on the coronavirus and, it's still playing out. But other risk factors to bear in mind, you've got the US elections coming up. The Democrats are going through their nomination process, and it looks like Bernie Sanders is, in the lead. And the markets are nervous about him. And that's also one reason why Wall Street has corrected. Bernie Sanders is a democratic socialist. He believes in populist policies. And some of his, planned policies are not exactly the best piece of use for stock market. So the US elections will come into the forefront in the second half of this year because the Democratic Party will nominate its candidate in July. And after that, we'll get a better idea of who will challenge Trump in the polls. And if a left-wing candidate wins the elections from the Democratic Party, that will not be the best piece of news for stock market. So that's going to create some nervousness. Secondly, I think trade protectionism. Yes, we've got the phase 1 trade deal in China, but will it hold? And will Trump open up new trade wars with Europe and other countries in the second half of this year? That continues to play on the minds of investors. Right now, it's not there, but it could come back into the forefront once the coronavirus takes a back seat. And of course, Brexit. Everybody's focusing on the UK to see whether they can strike a trade deal with the EU. Boris Johnson has set himself a very tight timeline by the end of this year. Canada took 9 years to work out a free trade agreement with the EU, but Boris Johnson is planning to do it in 9 months. Will he be able to pull it off? If not, then the UK is going to see a hard Brexit, no deal Brexit. That's going to spook investors as well. So still quite a bit to worry about in the coming months. So what's the best strategy given all this backdrop? I think firstly, in the short term, it's quite clear that the global economies are going to take a hit. What is happening with China and elsewhere will clearly hurt the global economy. But I think if this saga comes to an end fairly quickly, then I think the global economy can get back on its feet and go on. Now, the economic fallout is mitigated to some extent, as I mentioned earlier, by fiscal policy and also monetary policy from central banks. And of course, the market fallout is mitigated to some extent by low interest rates and the abundance of liquidity. So yes, we are going through a challenging time, but I think once we go past the virus saga, hopefully it's a short one, I think economies and markets will get back on their feet. So what do you do as far as your investments are concerned? Equity markets expect greater volatility, possibly more downside bias in the short term as the virus makes more headlines. The markets are now focused on Italy, the US, Korea to see whether this virus is going to spread. But don't lose sight of the medium-term prospects. Remember that before this virus came into play, the markets were focused on green shoots of economic recovery. That could, regain traction once this episode comes to pass. And the markets could then see a very good rebound. Bond markets, we still think they have a place in investors' portfolio. Interest rates will stay low. Central banks have no reason to raise rates given all the uncertainty and headwinds. That means that high-yield bonds will continue to be sought after. So how do you invest in a market like that? I think it's very important to stay diversified. In other words, have a bit of equities, a bit of bonds, a bit of gold in your portfolio as well. Stay diversified across asset classes as well as over time. Through dollar cost averaging, I think nobody knows where the bottom is. The coronavirus is still playing out. I think you can reduce risk by diversifying. So Kelvin, with that, I come to the end of my presentation and I pass back to you.
All right. Thank you, Vasu, for sharing those views. I think it's a very, very balanced perspective in the face of all the news that we've been facing recently. So to our audience, we have another esteemed speaker. Without further ado, I would like to invite Carmen to share her views on the Singapore equity outlook. Carmen, please. Yeah.
Okay, I think this further to what Vasu said about the year last year being a very interesting year, and yet the market ended up higher than at the beginning of the year. Similarly, for 2020, I think we started the year with several key events, which of course have been overshadowed by the coronavirus. But if you do recall, I think there was the Hong Kong protests, and obviously the volcano eruption in the Philippines, fire in Indonesia, and of course the flooding in Jakarta. And all these events will continue to play out this year. I think in addition to what Vasu shared about the US political scene and the election. So I think this is how we have started the year. But obviously at this point in time, the main focus in the market is on the coronavirus. And as a result of that, there has been a diversion in terms of the market indices as well as some of the key indicators. If you look at it in terms of the US market, it has continued to pile on gains. If you look at the MSCI World Index, it has also continued to pile on gains. Obviously, the diversion occurs largely in Asia, where the coronavirus is at the epicenter. So having seen that, you look at it in terms of the index, it's actually been moving up and down. And this last 3 to 4 weeks has seen quite a fair bit of volatility in the market. If you look at bonds have been trending up, as Vasu shared earlier on. And I think the Asian equities, in particular the Chinese equity, took the brunt of the selling pressure in the last 2 to 3 weeks. So basically, what is the impact from this coronavirus, and what's the impact on the Asia market? I think if you look at it, as we shared earlier on, the growth impact is actually quite significant. On the GDP front, I think on the China front, we're actually seeing about a 0.5 to 1% decline. And that is a similar trend for the Singapore market. For the Singapore economy, we are actually projecting about another 0.5 to 1% drop in terms of the GDP growth. So as shared earlier by Vasu about the budget, Singapore is one of the first to roll out its budget for 2020. And if you look at it, it's a very interesting set of pro-business initiative to help certain affected industry. And of this, I think some of the key industries that will be very severely affected this round will be your tourism, your hospitality, and some of the leisure-related companies. And the bulk of the measure will actually help this company to ride through this whole period. I think the fact that we're going to stay the GST at 7% is another positive sign. And another positive sign is the rental rebate as well as the property tax rebate. And all these measures cumulatively should help us to ride through this crisis. I want to share this chart, which is actually about the MSCI World Index. Just to give a bit of background, I think if you look at the black line, it's actually the average line. And the blue line is actually the plus minus 1 standard deviation. And the orange lines are the plus minus 2 standard deviation. Typically in the market, you expect the index to trade between plus minus 1 standard deviation. So a look at this chart shows you that based on the MSCI World Index, it's actually reached between the plus 1 to plus 2 standard deviation, which means that it's a little bit overbought at this point in time and a little bit expensive. This is the S&P 500 index chart, and similarly it's displaying the same kind of trend. Basically what this tries to tell you is the fact that valuation in the US market is actually at the plus 2 standard deviation, which typically means that it's a bit expensive. But having said that, do bear in mind that the US index has a lot of very high growth big companies that continue to develop very good earnings growth, which also in a sense justify the higher valuation. This is the CSI 300, which is typically used to reflect the Chinese market. And obviously with the crisis, the index is now trading at close to the normalized range, which is around 0 standard deviation, and which also means that there is some value in the market. But at this point in time, as the coronavirus situation is still evolving, we advise that clients be a bit more selective and be a bit more careful in terms of stock picking in this market. This is the Hang Seng index, and if you look at it, it's now trading between 0 to minus 1 standard deviation. And typically, if you look at it, it means that there is value in the market. But again, having said that, in the next 1 to 2 months, this situation is still evolving, and we expect a bit of a disruption in the market as well. So there's really no hurry to get back into the market. But do bear in mind that in terms of valuation, it's actually very, very reasonable at this point in time. This is the Straits Times Index, and Straits Times Index is now at close to minus 1 standard deviation. What is really supporting the market, and in an interesting manner, is the fact that the Singapore market has always given you a very good dividend yield. I think historically, if you look at the last 10 years or so, the STI has given you yield of between 3 to 4% in terms of dividend, and that should provide a very strong support for the Singapore market. So in a snapshot, this is basically what we're trying to tell you. If you look at the box that is actually in the red segment, it actually goes to show that Asian market, in comparison to the rest of the world market, is offering much better value. But again, this is because of the fact that this round, in terms of the selling pressure, the Asian market bore the brunt of it right at the beginning, versus now you can see that has actually moved on to some of the US indices. In terms of tactical allocation, I think we still continue to have a slight overweight in terms of the fixed income side, but just a little bit more on the equity front. I think we still continue to have an overweight for Europe, Asia, and Asia ex-Japan as well.
Okay, so thank you, Carmen and Vasu, for providing such useful insights. Again, I think with all the news that's been happening, our audience would really appreciate a lot of these insights. Now, let's look at some of the questions that have been posed by our participants. So just a word out to our audience. We only have a limited amount of time, so we may not be able to answer all your questions. Please speak to your relationship manager should you need follow-up on any of your questions. So let's come now to the most interesting part with regards to this evening's webinar. We have quite a series of questions, so I'll just go through one by one. I think first thing, this seems to be a common theme. How are we anticipating the coronavirus to impact in terms of the local economy and in terms of the global economy?
Well, things are still playing out, Kelvin. So it's difficult to be very precise. But in our view, as far as the Singapore economy is concerned, essentially we are looking at the economy growing at perhaps 0.7%. if the impact is mild, and 0% growth if the impact is severe. As far as the world economy is concerned, I think it's very hard to put your finger on exactly how that's going to impact the world economy. But the IMF has only reduced world economic growth rate by 0.1%. They were forecasting 3.3%. They've reduced it to 3.2%. So the IMF at this juncture anyway is not looking for a big fallout in terms of the world economy, but clearly, China is at the epicenter. China is the factory of the world. There are big linkages between China and the rest of the world. And if this prolongs for a fairly long period, Kelvin, then it will impact the world. It will impact Asian markets as well.
Sure. Thanks so much for that. So we have another very interesting question. I think what the audience is actually looking at is, given this kind of market conditions, what would be the best asset class that one should be looking at? So,
well, I think it's not a good idea to throw all your eggs into one basket. So perhaps I think, as I said in my presentation, taking a very diversified approach is very, very important. This is not the time to take concentrated bets in the markets. So there are opportunities, or there will be opportunities slowly that emerges in the equity space. There will be opportunities that emerge in the fixed income space, especially in the high yield segment of the fixed income space. Gold is an interesting portfolio diversifier to add to the portfolio. So there will be opportunities in different segments. In Asia, for example, which has taken a beating, I think at some stage things are going to look interesting, and investment opportunities will present themselves in that region as well. So I think it's important for investors to adopt a very diversified approach. I would prefer that we don't throw all your eggs in one basket, and also to spread your investments over time. In other words, to diversify over time through dollar cost averaging, because none of us can be sure exactly where the bottom is. So I think if you're not sure where the bottom is and you see big pullbacks and you want to buy, I think buy some and then save some dry powder for later on.
Yeah, I think that's a very, very interesting point, especially with regards to the dollar cost averaging. I mean, it allows you a position in the market, and yet also allows you to participate and also control your risk to some extent.
That's right. That's right. So I think it's important that investors do that.
Sure.
Okay. I think, can I just add to what Vasu said? I think we definitely need to diversify and definitely need to have a wider portfolio. I think, having said that, in terms of even the equity space, we also need to diversify. I think try not to have a concentration on too much of the Asian stocks. I think you should also have some of the US stocks, European stocks. And I think also it has become very clear there's a divergence in the market between the old economic sector stocks and the new economy sector stocks. So I think that there's been a trend towards favoring the disruptor, the new technology, the internet, the e-commerce, online payment gateway, gaming, etc., etc. And this round, in fact, it has become very, very clear that this segment of the market has done very well. Whereas the traditional companies have actually, in a sense, taken the bulk of the selling pressure. But having said that, these are also the companies that will provide you with a stable sort of dividend yield as well. So do bear in mind to also diversify within the equity space itself and not just focus on certain favorite stocks.
Sure. And that's an excellent point, Carmen. And also it brings to the next question from one of our audience. So specifically for the Singapore market, are there any particular sectors that one should be looking at given the coronavirus impact?
Okay. I think this round is very clear that there's been this chase for yield, and we've seen that very clearly in terms of the fact that a lot of people are going to the defensive, high dividend yielding companies, as well as the REIT stocks. So the REIT sector has actually performed very well last year and continue to power ahead this year. In particular, if you look at it, like data centers, which are deemed to be very defensive, have done very well. One of the stock, which is Capital DC REITs, in fact, I think the price has almost doubled in the last 12 months or so. That goes to show that people are still chasing for yield, and so REITs will continue to do well. But especially for the STI blue chip companies, I think typically most of them give you a dividend yield of about 4%, and that should underpin the share price.
I see. Okay, thanks so much for that, Carmen. And yes, another question with regards to asset classes. I think it's a development from one of the previous questions with regards to gold. So for this question is more, should one be looking at any specific country debt? And by country debt, I'm assuming bonds. Where should one be looking to park their money on bonds versus gold, let's say, for example?
Well, I think you can have some gold in your portfolio. You can have some bonds in the portfolio. It's not a choice between gold or bonds. You can have a mixture of both, because gold serves as a hedge against all the risk that's taking place in the markets right now.
Sure.
And bonds offer you that yield, that kicker. I would prefer not to go into individual securities. My preference would be basically to look out for funds, that give you exposure to, high yield bonds. And I think looking ahead over the next few years, I think interest rates are likely to remain low. Economies are still rather soft. With all this uncertainty, central banks are going to keep interest rates low. And so as a consequence, we think that, high yield bonds will continue to be sought after. And the best way to perhaps play into the high yield bond segment, many of them are in the emerging market space, would really to be buying into a fund, a unit trust that, allows you exposure to that segment of the market.
Yeah. So hearing from some of your views, there seems to be the outlook that emerging markets could actually come out of this quite well. Is that the sense that I'm getting from you?
Well, emerging markets have taken a bigger beating, so far this year because of the coronavirus.
Sure.
And, of course, essentially they are more exposed to risk. They are seen as a riskier proposition. So when investors are de-risking, what happens then is that, they take the money off the table as far as emerging markets are concerned. Now, the flip side to that is that, if you see further sell-off in emerging markets, then valuations now come down to more attractive levels, and that can present interesting opportunities, because don't forget that central banks in emerging markets may be ready to cut interest rates further,
Sure.
and that could help fuel interest in emerging market stocks. So there's a silver lining. Every crisis provides a silver lining, and policy action, especially among emerging market central banks, and the sell-off in emerging markets could actually eventually provide some very interesting opportunities as far as emerging markets are concerned.
Okay. And of course, it wouldn't be a OCBC webinar without questions with regards to property. So the specific question in this case is, do you think that the Singapore government would look at revising some of the property measures that they have been incurring over the past couple of years? Yeah.
I think if you look at the recent government announcement, they did indicate that they are unlikely at this point in time to remove any of the measures. But having said that, if you look at the property prices, it has actually been steadily increasing in the last 2 to 3 years. Even last year, it was actually up as well. And this year, we're going for a low single-digit increase in terms of the average selling prices. In addition to that, there are a lot of property stocks that actually offer you exposure to the property sector. So for clients which are not so sure about where the whole physical property market is going, I think a good proxy is actually the property stocks, which have actually suffered quite a significant correction recently because of this whole coronavirus. Whereas if you look at the physical property itself, I think the first 2 months of this year, in terms of new property sales, most of the units were moving very, very well. So I think some of the recent launches actually saw very good sales. So for investors who are not sure whether they should get back into the physical property market, I think the property stocks listed in the Singapore market actually does offer much better proxy play than the real physical property. That's something to consider as well.
Yeah, so from your point of view, the equity itself would be a good substitute for exposure to physical property.
Yeah, and I think do bear in mind that typically stock market is about 6 months ahead, right?
Sure.
So I think the recent correction actually should also capture what we expect for the next 6 months. So it's obviously like what Vasu said earlier, very difficult for us to time when the bottom is going to be.
Sure.
So again, it's all about having a balanced portfolio of stocks and having I think dollar cost averaging, buy progressively along the way, because I think it's very difficult to capture the low, and we could possibly be at a low, or it could go another 1-2 months of a volatility further down. But timing it is almost impossible. So it's actually good to just progressively accumulate.
Sure.
Yeah.
That's a very interesting point. In fact, I think over the weekend there was some article with regards to some of the property launches. It was quite well attended. So despite a lot of concerns of the virus, I think people, or at least Singaporeans, continue to look out for property as one of the main.
And Kelvin, I mean, I think the flip side to that is that what it tells you is also that there's a lot of money on the sidelines. And in uncertain times, some buy gold. Many of them actually buy property, given the penchant for property among Singapore investors, Asian investors. So there's a lot of money sitting on the sidelines. And pullbacks in markets like this, will then present an opportunity for this money to get back in and buy. And so when the dust settles, that money will go to work, and you could see a pretty decent rebound.
Sure, and I like the word they use, opportunity, because it's precisely in cases like this where opportunities would actually present itself, and that's where some investors can actually get into some very interesting opportunities.
Exactly.
Okay, so moving on, past property, which seems always to be the perennial focus. There are questions with regards to the Singapore, to the dollar Sing exchange rate, which so the dollar Sing has actually moved past the 140 handle recently. Any thoughts on the direction going forward? Yeah.
Well, the dollar Sing is now very close to the 140-ish, like you said, about 139 plus. The big question mark that remains on investors' minds is whether the Singapore Central Bank will ease monetary policy when it makes a decision, I think sometime in the next couple of months.
Sure.
I believe sometime in April, the monetary policy statement from the Central Bank. And the government has unveiled a very sizable budget that is intended to offset the coronavirus. Question is whether the Central Bank will now ease policy further to complement the stimulative the fiscal policy that the government has announced. So if the MAS does ease policy, then clearly the Sing dollar could weaken further. But I think it remains to be seen. The virus situation is still playing out. If things start settling down sometime towards the end of March or so, then and people are not so nervous about things, and things start looking a bit better, then perhaps there is no reason for the central bank to do anything too aggressive. So the big question mark is whether the central bank will act. Whatever it is, the Sing dollar has depreciated quite significantly against the US dollar. It's depreciated 4% against the US dollar year to date. Other Asian currencies have depreciated 2%. So a lot of the repricing has taken place to some extent. So we will not expect a big move on the Sing dollar from the current levels.
Sure, thanks for that, Vasu. So, Carmen, I think this is a bit of an expansion from the previous REITs question. So how do you think that REITs will perform this year in 2020 with, given the impact of the coronavirus? I noted you mentioned something about the data center REITs still doing well. What about REITs that have been underperforming given the current news? Is it a good opportunity to be looking at some of these REITs?
Okay, I think for the REIT sector, there are many segments of it. One obviously is commercial, retail, hospitality, data center, as well as also hospital. I think that if you look at it, the hospitality REITs took the bout of beating this round, largely because of the fact that hotels and service apartments will be impacted by the whole coronavirus. Sure. But the industrial and the commercial space are actually fairly stable. The other segment is obviously the retail sector, which is where the government is coming with the incentive to help them right through this whole period. And the government has actually openly said that if need be, more incentives will be introduced as well. So I think that should give them a bit of a breather. So in that context, you can see that actually there is opportunity within certain segment of the market. Sure. And currently, at this point in time, where the interest rate environment is actually very, very low, the differential between what the government is offering you versus what you're getting from your REITs is still fairly interesting. So it's still almost about 300 basis point, which actually still makes for a very compelling case for REITs. But if we have to focus on which segment of the REIT sector to go into, we'll still stick with maybe the industrial as well as the commercial side. And at this point in time, maybe just be a bit more cautious on hospitality and the retail REITs. Yeah.
I see. Okay, so this is a bit more of a fundamental question, which I'll open to the both of you. So do you think that central banks, given that the central banks have been doing a lot of easing measures over the past couple of years, would they be running out of ammunition in terms of monetary policy, especially given this current situation? What are your thoughts with regards to that?
Well, I think the Federal Reserve cut interest rates 3 times last year. But before that, they increased interest rates, I think, 9 times. So there's room for the Fed to cut interest rates even further from the current levels. Sure. We're not back down to 0 yet. Yep. The Fed fund rate is now quite clearly about 1.75% or so. Yep. So there's room for the Fed to cut interest rates further. Interest rates and monetary policy in Asia could be eased further. Sure. There's room for Asian central banks to cut further policy. I mean, the Chinese central bank, for example, has cut interest rates in the last week or so. Sure. They could do more, and not just cut interest rates, but also cut the reserve requirement ratio. The ECB could go back to increasing quantitative easing. They could step up QE. The Bank of Japan is more limited in terms of its ability to undertake monetary policy because they've got very, very loose monetary policy already. But other central banks around the world, I think, still have room to ease further. But of course, they will not be able to ease as much as they did during the global financial crisis of 2009. Yep. They have already done quite a lot, but there's still room. What's interesting is that where monetary policy may not be able to do enough, fiscal policy will have to step in, and governments have not perhaps spent as much in the last few years. They've been tightening their belts. They've left it to central banks to undertake policy stimulus. Governments have the ability to now spend. They have to step in, and this is what the central banks are telling the governments. For example, the ECB is telling European governments, you have to spend more. Sure. Germany, please spend more because, we've done quite a lot already.
Okay. So again, onus will be on the governments to make sure that they are doing their part as well.
That's right.
All right. Right. Thank you. So, Carmen, I think this is something that that's more equity related. So, what is your view with regards to the US technology sector? Are there any particular drivers? Are there any particular risk that will be affecting this sector per se?
I think this sector has actually benefited somewhat from the coronavirus because of the fact that people tend to stay at home. I think there's a need for a lot more data center. Sure. Cloud technology is actually very much in play now. So you see a lot of the cloud-related companies have done very well. Sure. Similarly, for I think some of the bigger companies like your Facebook, Amazon, I think content provider, home delivery services, etc., these companies tend to actually benefit this round. And I think that if you look at it, the market is a global market. It's no longer in the past whereby I think most companies have only the domestic market and a small portion of it as an external market. The big technology company, they say, if you call them technology, they're more internet media rather than technology, but classified widely as a technology company. They've actually used the whole world as their market. And I think with this fear of going out and looking for alternative sort of entertainment, Netflix has come back into play quite nicely. And a lot of the data center in the US, Equinix, GDS, etc., they are not really actually at all-time high, largely because of the fact that there's really a strong demand for data center, cloud, e-commerce, etc. So, which is why I said that the new economy stocks have actually outperformed the old economy stock. And I think this is likely to sustain for the next couple of months as well. Yeah,
this reminds me of an article that I also read over the weekend that you can actually stay at home and get just about everything delivered to you. You can provide you have home entertainment, you have food delivered, you can get your clothes sent in. Yeah, so it's to your point, I think really very much a new economy right now as compared to what we are quite used to previously. All right. Okay, so moving now back away from equities, back to FX. Another perennial favorite is with regards to the Aussie. So the Aussie dollar has actually hit one of the lowest levels that we've seen over the past couple of years. I think that's on the back of interest rate cuts and some of the outlook that's coming in from Aussie. So maybe Vasu, what are the odds if the Aussie, could it rebound in the year 2020, or are we expecting it to continue to resume its downward trend?
Well, a lot hinges on China. Whether the Chinese economy will, fall off the cliff, see a very sharp slowdown, because Australia is, after all, very closely linked with China. Yeah. And, the prospects for the Chinese economy will clearly have an impact on the Aussie dollar. And, it's hard to be terribly positive on China at this juncture, given the COVID-19 virus. I think at this juncture, investors are worried that the Chinese economy could slow down. Question is the extent of the slowdown. So I think that's going to weigh on the Aussie dollar, at least for this year. And that's something to think about. Of course, when things start looking better as far as China is concerned, then the Aussie dollar could see a rebound. But a lot hinges at this juncture on China. And this weekend, China will be announcing its PMI numbers for Friday. And it will be interesting to see what those numbers are, because that will give you the first clue of how the Chinese economy is doing post COVID-19. So the markets will be watching very closely this weekend for the PMI numbers coming out of China.
Yeah, and I think to the point for Australia, I think they just recovered from that from some of the natural disasters.
Precisely.
And to have this as well. So
it's a double whammy.
Yes, a bit of a double whammy for the economy. All right, so going by our previous theme on new economies, so again, another question, but this is slightly related out of the traditional asset classes. So any comments about investing in cryptocurrencies? Do you have a view with regards to whether cryptocurrencies is the way to go? Yeah.
Well, our view has also always been that, cryptocurrencies are speculative in nature. We would not advise, investors to, consider cryptocurrencies. We are careful about it. We are cautious on cryptocurrencies because cryptocurrencies are positioned as, the alternative to traditional money, traditional currencies, fiat money.
Sure.
But really, will they take off in a big way? Will central banks endorse unfettered access to the cryptocurrency market? So there's a lot of speculation that's going on right now because of digitalization, the advent of technology, and many investors are pretending this forward and saying, look, it means that cryptocurrencies are also going to be the new in thing, and therefore jump into it. And so we are a bit careful because we think that for it to be accepted as a medium of exchange, you need central bank endorsement, and central banks are not just going to allow just anyone out there to launch a cryptocurrency and attract money. So one has to be careful. I mean, there are a lot of other opportunities elsewhere. I would rather crave cryptocurrencies than this.
Okay. Yeah. Thanks for that. So the next question, I'll put it to Carmen. I think it's very much linked to the to equity indices. So the question is with regards to equity indices, specifically the Asian ones. They're trading at a bit of a discount, at least as compared to their developed market counterparts. Should we then be looking to buy into some of these Asian market indices, given that it's cheaper?
Yeah. Okay, I think earlier on when I showed the chart, it just definitely showed a trend that actually Asian equities are trading at a discount to historical averages versus the US market. By traditional methodology, that also means that American and European stocks are actually more expensive versus the Asian stocks. But having said that, I think because of the what I also say about the fact that the coronavirus is still evolving and the situation is still fairly volatile, then when do we go in and what is the load? That part of it is going to be very difficult. I think back to our earlier suggestion that you should still do dollar averaging. I think there will be a lot of opportunities in the coming weeks to actually really buy at dips. And I think that we should use that opportunity very effectively. Again, my point is that you have to buy across various. I think you still need to have a pot in very stable core companies that give you a very good dividend, and so that will be able to provide you that recurring income. I think some of the new technology companies or new economy companies are also worth considering, and obviously REITs have a bit of REITs as well. And I think Asian companies have also gone into the e-commerce space fairly rapidly. I think this is no longer the domain of the American companies. So do look at some of them. And I think the coronavirus has actually created a whole new segment of demand, especially in China, whereby I think the people who are staying at home are ordering food in more, are watching more entertainment programs, etc. And these are the new economy stocks, which are quite interesting. And on price dip, I think they are worth considering as well.
I see. Okay. Thanks for that. And given we have quite a bit of questions, and thank you so much for your for all your insights. I think in the interest of time as well, I'll just look at the final question, and this is what I hope that our audience can actually take away with. So I think this is something that is not so much related to any specific asset class. What are some of the key data points that we can look at in the face of the coronavirus to have a sense as to whether or not it is tapering out or that it's ending per se? Do you have any thoughts on that?
Well, I think if you go back to SARS, what you see is that, SARS broke out in November of 2002. China reported SARS in February of 2003. And SARS infection levels, for SARS started peaking somewhere around April, May of 2003. and then, SARS came to an end in July 2003. And what you see for the markets is that the markets bottomed somewhere around March, April of 2003 in response to the peak in infection numbers. So the infection numbers would be something I'll keep a very close eye on. During my presentation, I did show a couple of charts on total cases as well as new cases. I'll be looking out to see whether the total cases chart will start hitting a peak and coming down, or maybe leveling off rather. And I'll also be looking out to see whether new cases will start, coming down. Not so much in China, but perhaps more so elsewhere in the world. Right now, it's spiking up, so we're not there yet. But when the total new cases start coming down, especially outside of China, I think that becomes a very interesting, point for the markets. I think the second thing is to look out for data points in China, especially the Chinese economic growth numbers. And if you see the PMI numbers in China starting to pick up, I think that's again a very interesting thing for the markets, because it shows you that the Chinese factories are getting back on their feet, starting to produce more. But there's usually a lag effect between China and how China performs and the SARS infection. So to me, the key number is really the infection numbers. I'll be keeping a very close eye on the infection numbers. If they start showing a sign of peak, I think then that looks very interesting. Then but even if they do peak, Kelvin, the thing is that going to the second half of this year, we got US elections. So if it's not a virus, it's going to be other uncertainties. So we may not get out of uncertainties completely, but at least we will go past the virus, I think.
Thanks for that, Vasu. And Carmen, maybe any final comments?
I think uncertainty is here to stay in any form. I think be it the Brexit, be it the US election or the coronavirus, I think that we should still stay invested, stay calm, and obviously stay healthy.
And those are very, very important words. And just as a key takeaway from all these insights and all these comments, I think to the point that we wanted to remind our guests as well is that in every case, there's always the chance for opportunity, and that we should be also looking past some of the daily news that we see.
That's right.
And to look at the underlying chances, the underlying opportunities.
Precisely.
Yeah. So thank you both so much for your time.
Thank you.
And to our audience, we hope you have also benefited from today's sharing session. Thank you so much for your questions. So this brings us to the end of our investment outlook. Thank you for joining us this evening, and stay healthy and stay safe. Thank you, everyone.
Thank you.